Okay, so in this video, we are going to talk about using DR-IDR for finding our daily trading bias. And this concept is originally from Master 7 or Master, I believe. And before starting this video or the lesson, I want to preface this by saying this concept goes a lot deeper than what I am going to cover. I am not going to cover every single thing about this concept because I don't deem it necessary. But if you do want to find out more about this concept, I will be linking down his channel in the description below. Another thing is nothing is fail-proof. Again, no concept is, and I do recommend you rewatching this video. Stick to this video. If you find it kind of hard to understand, leave your questions down below and I will do my best to answer, but I would just recommend you to watch it. Don't take any notes, just watch it, rewatch it if you have to. I think people generally understand a concept better by just rewatching the video a couple of times. So without further ado, let's get into it. Now, some info that we need to go over. The first thing being is, what is DR-IDR? So the DR-IDR, defining range or implied. This concept is based on the idea that price action in the first hour of the New York, Tokyo, or London trading session, whichever session you're trading in, is often indicative of the overall direction of the market for the rest of the trading day. So like I said, this concept generally gives you a bias for whatever session it is that you're planning on trading in, right? Now next is the types of sessions that this concept applies to. So the DR-IDR concept can be used to trade both the New York session and the overnight session. Now you can trade Tokyo or London, but generally it's best to try this on New York. For the New York session, the DR is defined as the first hour of trading, 9:30 a.m. to 10:30 a.m. and the IDR is defined as the range of the entire trading session. And for the overnight session, the ODR is defined as the first hour of trading, 3 a.m. to 4 a.m. Eastern Standard Time or New York time. And the OIDR is defined as the range for the entire overnight session. The next thing is timeframes. So the DR-IDR concept is typically applied to the 5-minute time frame, but it can also be used on other time frames like the 1-minute and 15-minute. Now technically it's really just meant for the 5-minute, but I personally use it on the 1-minute and 15-minute time frames. Next, instruments. It works for all major Forex pairs, Bitcoin, Ethereum, and US equity indices like NAS 100, S&P 500, so on and so forth. But typically, I would recommend you try it on Forex pairs just because it's the easiest to work with, but it does work on everything else. You just have to backtest it yourself. Next, the probability of success. So Master claims that the DR-IDR concept has an 80% probability of success. This means that there's an 80% chance that the price will respect the DR-IDR levels. Now, I'm going to be completely honest here. I don't think that this actually has an 80% probability of success. That and people that have already been testing this concept since this came out also claim that this is a bit exaggerated. But you can backtest this yourself and see if there is some sort of truth to this. But again, personally, I don't think this is accurate. But I do think there is enough success in this that's worth using it or worth diving into. Next, the limitations of the DR-IDR concept. The DR-IDR concept is not foolproof, and there is no guarantee that the price will always respect the DR-IDR levels. It is important to use the DR-IDR concept as a guide, but not as a substitute for sound risk management. So again, guys, there is no concept that is fail-proof. It's just that we have to take whatever we can get and make it as best as possible. Alright, so now let's start with the anatomy of this concept. The highest wick created by a 5-minute candle during the DR time frame is considered the range high or the high of the defining range. And the lowest wick created by a 5-minute candle during the DR time frame is considered the range low, or the low of the defining range. So I have a quick example of what I mean. So as you can see, during this formation period, this wick is the highest wick out of all of the high points, or the high area, meaning that this is the high of the defining range. And down here, the lowest wick is the low of the defining range. So really it's just the biggest wick out of the top and the bottom. And in this case, this wick was bigger than this one, so this is going to be our lowest wick, equaling our low of the defining range. And again, same here, this is the highest wick, or really the only high wick, making it the high of the defining range. It's that easy. Next, the body closure high of the 5-minute candle is the implied defining range, or the IDR high, and the lowest body close is considered to be the IDR low. From there, the midline is calculated using the IDR. So again, another quick example here. So as you can see, this is the highest wick that we spoke about earlier, and from there, the body of that high wick, it's going to be our IDR high. Remember, candle body. Same thing here. The candle body closure low, this one right here, is going to be our IDR low. And as you can see, it's connected to the biggest wick. From there, the midline, or equilibrium, or 50% zone, whatever you want to call it, is calculated. So from here to here, that midline is formed or calculated. That simple, that easy. And remember that the theory behind this is that once this range is formed and it is broken in one direction, price is most likely to not trade past the opposite end of that range. All right? And you'll see what I mean about this concept in a few minutes. But for now, let's continue. Now let's go over the rules. The confirmation rule. If after 10:30 a.m. or 4 a.m., whichever session you're trading in, the closing price represented by the body of the candle in the 5-minute time frame is higher than the DR's high, there's an 80% chance that the lowest point for the rest of the day will be the DR's low. This is called confirmation. Confirmation rule for the opposite direction. On the flip side, if the price closes lower than the DR's low after 10:30 or 4 a.m., there's an 80% chance that the highest point for the rest of the day will be the DR's high. Again, this is called confirmation. And lastly, early indication rule. If the price closes above the IDR high after 10:30 a.m. or 4 a.m., it's a sign that the DR's low might be the lowest point for the day, and vice versa. Remember, this is not fail proof. So just a quick review. When I talk about the closing price after 10:30, we are using the body of the candle, not the wick. We don't care about the wick closing over the DR high or low. We want a body to close over that area. Again, you'll see what I mean in a short minute, but I have to emphasize this part. It's very important. Now, let's move on. Okay, so let's go over examples real quick. So for this first example, we're going to show you the example of rule 1. For the confirmation rule of a bullish bias, remember I said it has to be represented by a body to close over the DR's high? Well, this is what I mean. So let me zoom in for a little bit. As you can see, after 10:30, price started ranging a little bit, and then finally we had a body closure over that DR high, indicating that for the rest of the session we will have a bullish trend. And here, after 10:30, we have a body of a candle close over the DR low, indicating that the rest of the session will be bearish. And as you can see, the rest of the session was bearish. It's really that simple. There's not much more to this. I don't want to add more to this, even though I'm pretty sure I could. But again, it's that simple. And if you can, open up a chart, pause the video, and see what I mean. I have added an indicators section here on this presentation. So you can just download the presentation and open up the links and do this side by side. Okay, now let's move on. Okay, so example 2 of rule 3. So this is what I mean when I say might when price closes after 10:30 above the IDR. Okay, so let me zoom in. Okay, so after 10:30, this candle closed over the IDR, implying that there might be a bullish trend. And as you can see, there was a bullish trend, right, for that session. But as nothing is fail proof, we have one here that also closed above the IDR, which is this candle, this blue candle right here. And as you can see, the trend actually ended up reversing, going down. Now, let's say, just for this case, that if there was a bullish candle that closed above the DR high, then maybe, just maybe, we would have had a bullish trend. But that does not mean that it's fail proof. It could have probably, just like in this example here, right? But again, nothing is fail proof. So just always keep that in mind. If you can, try to only look for candles that as soon as after 10:30 hits, that you have a closure of a body above the DR high, or at least the first closure you see isn't above the IDR, but above the DR. So what are things that you can do to increase your results? So the first thing is determining the strength of the candle that closes above or below the DR or IDR. So let's say you have a fairly small candle, not too big. You can see that it barely wanted to close above the DR or the IDR. You might want to say, okay, you know what? I'm going to wait and see if price action plays out the way I think it's going to play out, right? Because more than likely, if you do not see strong momentum, it's probably not going to play out. So it's always good to look at the candle that's closing above these levels and see the momentum that it carries to see if it's even worth looking for a trade in that direction. Next is you can use the overall market structure to see if the DR-IDR bias aligns with the current trend, and maybe even using multi-time frame analysis as part of your confluence. So if you see that your bias for the day is going to be bearish because the candle closed below the DR range, right? But you're seeing that the overall market structure is actually saying bullish. So you might not want to trade in a counter trend direction, but if you do, then don't go for a big RR, go for a small one like a 1-to-2 or a 1-to-1. Next, you can actually use the ICT daily bias as an extra confluence. So I made a video about this, and you can actually pair both of these two things together and see if you can have a higher win rate or avoid losses when you don't have to take any. And you can even pair it up with any other form of daily bias that you might have, just as an extra confluence. Next, incorporating other concepts like order blocks, breaker blocks, fair value gaps, support and resistance levels, Fibonacci levels, higher time frame points of interest, etc., to see where price is reacting from when your DR-IDR range is forming. So as you can see, when this range was forming, there was an order block just under it, causing it a reaction, and then once it closed above the DR, you can see that the trend is obviously going to be bullish, right? So that's just an extra confluence that you can add. And then next thing is going down to a smaller time frame for entries, and I'll actually show you an example what I mean in a minute. But you can go to a smaller time frame to find your entries and even increasing your risk to reward that way. And lastly, you can use your Fibonacci tool for take profits. I'll also show you an example on this in a minute. Now, I know some people use moving averages when using this concept for overall market direction or even entries, but I personally don't use it. If you want to use it, you can go ahead. Maybe you might actually figure out a good method. So let's move on. Okay, so I want to show you a quick example on the charts on a few of the tips that I was just talking about. So here we can see that on the 5 minute, we had an IDR range here, and the candle closed above the IDR, but for extra confirmation we could wait for another candle to close above the DR, giving us a better confluence. So now that we know that on the 5-minute time frame this candle closed bearish under the DR, we can now go to a lower time frame and find an entry, or find a reason for an entry. So what do we have here? We actually have a nice fair value gap. So from here to here, can mark this fair value gap, right? We saw that it tapped in. You could have had an order here, you could have entered limit order style here, or as soon as you see the rejection on this candle, this engulfing candle, my favorite candle, you could have entered a short position here, set the stop loss above here. I personally, being honest here, I would have put it at least at the 50% zone. And then as always, lately I've been targeting a 1 to 2, and then after you get your 1 to 2, you could go for a little bit, something a little bit bigger. Now, how you could use your Fibonacci tool for your take profits would be drawing it from here, from this little recent swing point, down to here, to this area, and it's even perfect too. Look, this candle actually aligned to the 50% zone, even better. And you could have set your next take profit down to this level right here, the 0.27, and you would have got a 1.68. Perfect. And look how well it rejected off of that area. And if you want, you can copy my levels, which are here. Pause the video, just copy everything that you see. All right. So that is a way that you can use a smaller time frame to enter off of this area here, or this point of interest. And again, with a candlestick pattern, or you could have entered at a limit order style, and you would have been real good. All right. And this is using Bitcoin. Okay, I could have used anything else. I could have used Euro USD, but in this case, it was just to show you that this concept really does apply to almost anything. All right, so let's move on. All right, now for some Q&As. The first one, what is the retirement setup? The retirement setup involves a price movement that breaks one side of a defined range and then undergoes a significant retracement, like a really deep pullback. Traders take this kind of trade expecting price to reverse, since it typically only breaks to one side of the range. When the reversal occurs, it becomes a favorable risk to reward trade with minimal risk. Now you can again look up this concept or what the setup is all about in Master's YouTube channel, and I'm pretty sure he'll have a better explanation than what I just gave you, right? Next, would you recommend the ICT OTE fib levels to help with identifying deep retracements and entries? Yes and no. Yes, because you would get an amazing entry, right? You would get that nice risk to reward, a really big take profit, really good money, right? And no, because you will miss on a ton of setups. So you'll have times where you probably won't get that retracement that you're looking for, especially if you're on the 5-minute time frame. And yeah, you're just going to be pretty disappointed by price taking off without you. So just keep that in mind. Next, what other ICT concepts can I apply this to? So you can use a DR-IDR bias with ICT PD arrays, which seems to get some pretty good results. I haven't personally tested this enough, but from what I've been seeing, it does seem to do a pretty good job. Next is what instruments would I recommend testing this on? I recommend anything like GBP USD, Euro USD, S&P 500, NAS 100, US 30, Bitcoin, as I showed you. I've even seen some people claim futures, metals, and even oils to be pretty profitable, but you'd have to test it yourself. I don't want to give you false hopes either. And lastly, do I recommend joining his mentorship for further understanding this concept? The answer is no. And reason being is because he already has a ton of free videos on his channel explaining this concept. Not only that, his style of trading isn't definite. It's definitely not the holy grail of trading, just like everything else. And honestly, I think it's just way too much money for something so simple. And I've seen some reviews on this guy's mentorship. I'm not trying to bash him or anything like that. This isn't what this video is about. But a lot of people have been claiming that it's not their best investment. Okay, let me put it that way. But if you still want to try it, go ahead, give it a shot. I mean, let us know in the comments down below if anyone has already done this mentorship, and to see if it's worth it. And if it is, then yeah, definitely recommend it to to people if you think it's worth it. All right, cool. Now for the indicators that I've used, I have again attached them on this presentation. You can download the presentation, open up the hyperlinks, and test it out yourself. You know, like I said, you can even add the ICT daily bias to this. There's a good bit of indicators here, so definitely check them out, play with it, see what you can find. And if you have any good setups or any good trading plans to go along with this, please share it down below. I think people would really like to know if people are making money with this. So definitely recommend you checking this out. All right, now we are in the end of this video. Thank you so much for watching this video. I hope that I was able to clear out this concept for you. I sure did have a lot of fun testing this concept out and even using it. So if you found some value in this, please let me know in the comments below. Give it a like, subscribe, and yeah, I really did have a lot of fun making this video. And to end this video off, I want to read a Bible verse from Psalm 32:8, which is, I will instruct you and show you the way to go. With my eye on you, I will give you counsel. So again, thank you so much for watching this video. I really appreciate it. And I pray that you have a profitable trading session. And I'll see you guys in the next one. Peace.